Good morning, namaste to one and all present here. We all have gathered here for a one-day seminar on audits under Income Tax Act. Can I request our Vice Chairman, CA Pramodar Hegde, to escort our speaker for the day, CA N R Rani, Madam, onto dais and then welcome her with a floral bouquet. Thank you. I request our speaker, CA Deepak Chopra sir also to come out to dais. Request Pramod sir to hand over floral bouquet to him also. Thank you. I request Vice Chairman to give a welcome address.
Esteemed members of ICI, respected speakers, CA Deepak Chopra, CA N R Rani, a very good morning to all of you. It gives me an immense pleasure to stand before you. And first and foremost, I would like to extend a warm welcome to each one of you for gracing this seminar with your presence. The topic of our seminar, Audits under Income Tax, is both timely and crucial. Our aim today is to delve well into the deep nuances of tax audit to understand its intricacies and challenges. Today we are fortunate to have a panel distinguished speakers along with our dignitaries. We'll have CA Sumit Khurana and CA Shiv Shankar TR, who will share their insights, experience, and expertise with us. And I'm confident that their presentations and discussions will enhance our understanding and equip us with necessary tools and knowledge to excel in our profession. And considering the last tax audit and current tax audit, I know there are nothing more changes what has been prescribed by the government. But of course, as I thought today's seminar will aid us with the past mistakes what we have done and to prepare ourselves better. With this, in conclusion, I encourage all of you to actively participate, ask questions, and engage in the discussion. Let's make most of this opportunity to learn. Welcome again.
Thank you, Vice Chairman. I have a privilege in introducing today's speaker. CA Rani NR is a fellow member of Institute of Chartered Accountants of India. Rani has been a partner in G. Ananta and Co., a Bangalore-based firm of chartered accountants since 2004, and has garnered experience of more than 18 years in the areas of statutory framework relating to the not-for-profit sector and profit sector. Prior to that, Rani worked with Ernst & Young Private Limited for about 1 year. In addition to regular practice in the areas of audit and taxation, Rani's area of interest is in international taxation, for which she has completed the certification course from the Institute of Chartered Accountants of India and also diploma in international taxation from ICI. She has also authored a book on international taxation and co-authored books on transfer pricing. Rani also has a master's degree in business laws from National Law School of India University, Bangalore. Rani has spoken at various fora, including branches of ICI and the Direct Taxes Regional Training Institute of the Income Tax Department on matters relating to income tax and international taxation. I would like to introduce another speaker for the day, Deepak Chopra sir also. Deepak is a fellow member of the Institute of Chartered Accountants of India and has graduated in Commerce from Bangalore University. He qualified as a Chartered Accountant in the year 2011. He has a strong passion of direct taxes and has been regularly taking classes for students of Company Secretary and Chartered Accountancy courses. He was a regular faculty member of Bangalore branch of ICI for direct taxes class for students of CA Final. He has also been a resource person on direct tax matters at various forums, including at Bangalore, Mysore, Chennai, Hyderabad, Tumkur, Davangere, Mangalore, Tiptur, Hubli, Erode, Shimoga, Calicut, Udupi, Rajahmundry, East Godavari branches. He has been resource person for session hosted by committee for members in practice. He has also been faculty for officers of Income Tax Department at Direct Tax Regional Training Institute, Bangalore. He is presently serving as chairman of Direct Tax Committee of KSEAA, Karnataka State Chartered Accountants Association. He is founding partner in Deepak Neeraj and Associates, where he leads the Direct Tax Division. With this brief introduction, I present before you both the speakers. I request all the dignitaries on the dais and then our MC members also to join us for lighting the lamp.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनात्यति कश्चन एतद्वैत 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 एतद्वैत.
Good morning to all the members. At the outset, I would like to thank the Bangalore branch for giving this opportunity to discuss on the new audit reports which are applicable for charitable institutions. So, we had been witnessing tremendous changes in the statutory provisions which are relevant for charitable institutions in the past 2 years. Still, there are a lot of areas which have no clarity, which warrants tremendous judgment and application of principles when we do the audit of these institutions. First, they brought out the changes in the income tax return in the last year. So we were only participating or helping the assessee to file the returns. But this year, the entire responsibility has been cast upon the chartered accountant who is doing the audit, which has to be taken very seriously. So next 1.5 hours, I will try my best to whatever minimum experience I have gathered handling these charitable organizations. The thing is, this audit report, those who have done in the previous years, It was only a 3 pages or 4 pages report with 4 or 5 numbers to be reported, which was easily available. And this was never a nightmare, or rather, when we do a scheduling of audit in our office, I don't think in the audit of these charitable institutions was something which scared us, like a regular tax audit. But that is not the case, and since the report has come in the middle of the, after the financial year is over and they have introduced the form, the thing is, there will be a lot of legacy issues which the organization had been in existence, and of course they were compliant with the provisions, and as statutory auditors we had been taking care to ensure that they comply with the provisions relevant for them to enjoy the income tax exemptions. But we wouldn't have applied our mind to the basics of accounting systems. See, they would have been following some accounting systems which are convenient for them for their internal reporting, because there are multiple stakeholders for whom these charitable institutions has to submit their reports, unlike a for-profit organizations where the statutory authorities will be income tax authority, and also if it is a company or LLP, the Companies Act. Very unlikely, unless you are handling a listed company, very unlikely the stakeholders like shareholders will be relying upon the financial statements to get an understanding of the organization. Because most of the companies which you are handling will be a private company where the family members are the stakeholders, or maybe known people are the stakeholders. Very rarely I have seen they are relying on the financial statements to take a business decision. But in the case of charitable institutions, we have come across situations where the same set of financial statements have to cater to the requirement of multiple statutory authorities like Income Tax Act, and if it is a Section 8 company, the Companies Act, then there is a Foreign Contribution Regulation Act when they have foreign contributions, and the management of the organization also, they have very serious budget meetings, and they have donor reporting, they have due diligence from the donor. So this particular set of financial statements has to cater to multiple stakeholders. That is one challenge. And now above that, this statutory requirement also has cast upon responsibilities. So what I thought is next, see the entire form I have here for displaying. Let us see if the time permits, we can go through that. But before that, I would like to touch upon the basics, principles, the first principles or basic principles under which these income tax, these charitable organizations are working, and how they are expected to operate given that they have income tax exemptions, and also some critical amendments. And once we are able to appreciate these amendments and the environment and the statutory obligations which they have to comply with, I think appreciating the requirement in a form may not be a difficult problem for chartered accountant. And also there will be a requirement where, as I told you, we may not get the exact information from the books of accounts or the documents. There could be, there warrant a judgment or application of your experience to report the numbers in the audit report, because we have to file the audit report within the due date. So understanding the basic principles will really help. So let me start. Basics. So charitable institutions, so charity, we all understand charity. But for the purpose of Income Tax Act, there is a specific definition under 2 subsection 15 where the charitable purpose have been defined. So the institutions which are carrying out the so-called charitable purpose has to fall in one of these categories. Their activities, their operations has to fall in one of these categories which is defined under section 2 subsection 15 to call themselves as charitable institution. So there are precise definitions like relief of the poor, education, medical relief, preservation of environment, watersheds, wildlife, preservation of monuments and places of artistic and historic interest, yoga. So these are specific limbs where charitable purpose has been defined. And further, actually, they have brought in a, we can't call it as, actually it is a definition. They have put an umbrella clause, I would say, like any object of general public utility, wherein any activities which are beneficial to the public and not falling within the precise definition of this 5 limbs or 6 limbs, they have brought in under any object of general public utility. So what is the speciality of this any object of general public utility versus the other specific limbs? For example, if we have come across a charitable institution who are carrying out the activity of, say, relief of the poor, precisely they are addressing specific needs of poor people, and they got an exemption in the category of relief of the poor. How they get exemption, we will come across as we discuss. That versus another charitable institution where their activity includes social welfare, like not only relief of the poor. If somebody wants a medical help, somebody who has no money to meet a medical emergency, or somebody has no money to pay for education, school fees, or somebody is in need of a shelter. So any social activity, any person who is in need of money, there is an organization who is helping them. So now when the income tax department applies their when they make an application to the income tax department, the first organization which falls in the specific limb of relief of the poor will have no restriction as to the receipt and as to the activity they carry out. They have to make sure these activities comply with the specific objects which they have mentioned in the document with which the organization comes into existence. Whereas the organization which carries out any activity which is of relevance and where socially it is benefited, not falling in this specific limb, which have another rider which is brought in by way of a first proviso to section 2 subsection 15, where they have mentioned that these organizations which have got the exemption in the category of any object of general public utility, they can carry out any activity in the nature of trade, commerce or business, provided their gross receipt is within 20% of their total receipts. They cannot carry out any activity which is in the nature of quid pro quo if they are falling in the last limb. Now this is the basic definition of 2 subsection 15. Now here these institutions can be a trust or a society, or it can be a company under Companies Act, which is a private limited company, but they need to seek a specific license under erstwhile section 25 of the Companies Act, now Companies Act 2013 section 8, where they have been given the status of a charitable organization depending on the objects. Now, first and foremost principle we have to understand, like these, unlike a for-profit organization, this organization will have its own characteristics in the modus operandi. In the case of a for-profit organizations, we know that if you think basically any organization having for-profit motive will have a revenue stream, primary revenue stream will be either sale of the goods or rendering of services. So there are two parties involved in the transaction. One is a buyer and a seller, or a service provider and a service recipient. So the transactions definitely have a quid pro quo nature. The person who is coming for a service, the person who renders the service, and there is a consideration agreed upon, terms and conditions are agreed upon, definite deliverables are agreed upon, and the beneficiary is precise. The person who pays for it is the beneficiary. Now, those organizations which are, we call as charitable institutions, definitely minimum 3 people there should be there in the line of activity. Minimum 3 people. One is a person who is called the donor or the grantor, who is willing to give money for charity. So somebody has money at their disposal, or a property or an immovable property at their disposal, and they want to do or utilize these funds or resources for the cause of a general public. So definitely the person who is giving the money or a resource is not the beneficiary. That is the first and foremost condition. So these conditions, these basic things we have to keep in mind whenever we do the audit of these charitable institutions. Now the second person who is in the line is the donee, or the recipient of this property, who has the mandate, who is in existence and who has announced to the world that, look, I am here as a trust or a society or a company under section 8 of the Companies Act, that I am willing to utilize these resources which somebody gives me for the benefit of a general public. So the second person in the line is a person who has, in our layman's language, who has the responsibility cast upon only for execution. Now there is a third person, definitely there should be a third person who is the beneficiary. This is the first and foremost difference between a for-profit organization and a charitable organization in our basic understanding of the activity. Now who is the third person? It should be, it can be either a private person or a general public at large. Suppose the beneficiary is identified in the whole scheme of things. There is a donor, there is an executor, there is a donee, and the beneficiary is defined, and there is only that beneficiary. There are only specified beneficiaries. Then it becomes a private charitable institution. It becomes a private trust or a private, usually private charitable institution. Whereas, when the organization is announcing that the beneficiary of the activities which is being carried out, utilizing the resources given by the donor or a grantor, will be general public at large. That time you are calling yourself as a public charitable institution. So that is the first and foremost thing. So when you are getting into the audit of the organization, there is nothing wrong in revisiting. You had been doing the audit of the organization for the past 15 years. We know what they are doing, but still there is nothing wrong in going back to the basics and ask for the original document by which they have come into existence. If it is a trust, there is a trust deed. There is a possibility there are lot of amendments that would have happened over a period of time in the trust deed itself. Or if it is a society, there are bylaws, and as far as society is concerned, there is a Society Registration Act, and there are certain Societies Registration Act is a state legislation. There are certain states which have specific state legislations like Bombay Public Trust Act, Rajasthan Societies Act, like that. So go through that basic document, and in the case of a company, is a memorandum of association. So these objects should be, and the beneficiary should be public. Now, they should fall within the specific limbs of charity, and the beneficiary should be public. These are the two basic mandates. Now, if they comply with these mandates, the Income Tax Act told that if you are doing this for the benefit of the public, and when the benefit of the public happens, definitely there is no profit motive. You are taking the money in the capacity as a donee to execute the activity for the benefit of general public. Now, there is no profit motive. When there is no profit motive, the stakeholders like shareholders in the company or the trustees of a trust or members of a society cannot take a dividend. They cannot take anything out of the profit, unlike a for-profit organization. This is another condition. Next, any of the activities which the trustees or the members or the shareholders or the directors who are running the organization render to this organization in their capacity. Very common, what will happen, if it is a small time trust, the trustee themselves will be managing the whole activity. His full time is spent for running the operations of the organization. He has to make his livelihood also from that organization. So there will be a situation where they are taking a consultancy or a remuneration. Now, here the government wants to make sure there is a public money involved. They are not earning the money out of rendering or service and goods, and they are not for profit. So there is definitely a rider as to if any benefit is enjoyed by this so-called specified person. So this, whatever I am talking is there in my slides. This slide by slide, we may not get time, and also the idea is to enable, including myself, to do this audit. So let me explain the basic things, and we will come to this. If we understand this, there is nothing new in the slide. Everything, whatever I have reproduced, is there, is very much in the act. So coming back, there is no profit motive, so they cannot take dividends. Now next, in not taking profit, and they are getting a remuneration, or they are a consultancy, then again the government has put restrictions making sure that these specified persons should not be taking unreasonable amount. There are words, these words what I am using are very important, reasonable or adequate. Whether the compensation or the salary or the consultancy which they are taking for the rendering the services to run the operations of the organization is adequate or reasonable. Why? We can understand that question is very much relevant. The statutory authority is giving an income tax exemption to a charitable institution in the premise that you are taking the money from a person called donor who is giving you the money, saying that look, you use this money for the benefit of a general public for a specified cause. Definitely you should not be the beneficiary. You should not be taking a compensation where you have an interest to get yourself benefited, and the benefit, if at all, I mean whatever you are taking, should be reasonable or adequate. This is another principle you have to keep in mind. Then this is next principle. Now somebody gave the money. Now somebody gave 1,000 rupees. Now this organization has to be in existence. How much they have to utilize this money? Should they utilize the entire money, or how much they have to utilize? What is the mandate? What is the mandate for them to enjoy the income tax exemption? So Income Tax Act, they have told that, see, if somebody gives you money to do this activity, if you give 100%, if you utilize 100%, the organization has to be in existence, right? To carry on the activity, you have to be there. So when an organization has to be there, there should be an office space at least, or maybe in this virtual world, you may not need an office space, so at least minimum staff strength should be there. There should be a person who runs the organization. There should be at least one accountant to make sure the numbers are correct. There should be at least some person to make sure the activities have happened. And if the organization doesn't have an office space, they may need at least a space to carry out the thing. So for this, and you have to be in existence. Even if there is 1 year, see some activity is carrying on and 1 year you are not able to get enough money to sustain yourself, you keep something for yourself for you to exist. So they arrived at a percentage. Now out of the money what you come, the Income Tax Act told, keep 15%. There is a number. Thank God they never told adequate enough or reasonable enough or according to the judgment of the auditor or the income tax officer, they never told. They told precisely 15% you keep. The rest 85% out of whatever you are earning, please spend for the activity for which you have committed. So these percentages are very critical. That is very reasonable. Now we can, with this premise, if we can appreciate all the amendments and all the provisions which they have brought in. So they have told how you have to utilize the money or the resources which comes in. Now there could be a situation where, yes, theoretically we told that you please utilize 85% in the year of receipt. What? Where you have to apply 85%, I will come to that. This keep in mind this 85%. For simplicity, the money what comes in. 1,000 rupees came as a revenue. I will tell you what are the revenue streams. 15% you keep, 850 rupees you spend. There could be a situation where the money came towards the end of the financial year. We have an artificial cutoff. In a charitable organization, they cannot demand. This is a very important principle we have to keep in mind. Some donor has offered that I will give you 1,000 rupees to carry on your activity. You can humbly follow up. Look, you have committed, can you please give? You cannot go to a court. It is not enforceable in a court of law that somebody has committed to give a donation, and if they later say that no, I will not give the donation, the donor organization cannot go to the court. Because there is no quid pro quo. You have not created any obligation on the part of the donor to pay that money, because there is no rendering of service or there is no sale of goods. So the money has to come, and what happened? The donor promised at the beginning of the financial year, but he gave the money at the end of the financial year. On March 29th, he gave the money. Now there is no enough time to spend the money by we have an artificial cutoff of 31st March. There is no enough time to spend the money. What happens? So the government brought in the provisions. Why the provision is brought in? Because you cannot demand, you cannot do follow-up. You are at the mercy, or rather you have to wait when the donor comes. That is not in your control. So what they told, okay, some year there is a problem, there is a shortfall. The organization is not able to spend that 85%. Then they brought in relaxations. They told that if you are not able to spend it, two situations. One, the money come in such a way that you are able to spend within the next 1 year. One form you have to file. Everything you have to communicate. You have to commit to the income tax officer. You have to file the return at the end of the financial year. Within July or October, you have to file the return. You commit to the income tax department. See, look, I got this money and I will be able to spend within 1 year. You file. How will you communicate? We have forms. Forms, the purpose of form is to communicate our situation. Or there could be a situation, the money came in such a way that I may not be able to utilize in 1 year, or the money came with a specific mandate that this has to be utilized over a period of next 3 years. Say for example, for a specific purpose for carrying out some activity which will run from 3 to 5 years. So it is not utilized within 1 year, it will be utilized within next 3 to 4 years or 5 years. So another form, Form 10. So the first form where the utilization has to happen within 1 year, Form 9A. Another form is Form 10, where you are again committing to the statutory department that this money has come, we are going to utilize it. Fair enough. You have to commit that. So that is another requirement. Now on what this 85% or 15% has to be applied. The word used is income. Now in our common parlance, what is an income? Top line, or is it after setting off the expenses, the profit is what the income? Because in statement of total income in for-profit context, we take the profit from profit and loss account. Now for understanding that, let us understand what will be the common revenue streams for these categories of organizations. Unlike a for-profit organizations, predominantly the revenue streams we can put it in buckets. One is it's a big umbrella. When I show this is a big umbrella. It's a voluntary contribution, which I had been talking all along. Somebody has voluntarily agreed to give you money. give the organization the money, voluntary contributions. And other category could be interest from deposits. Because the money has come in, they have to utilize the money. On the first day itself, I will not use the money, or I need the money over a period of time. So instead of keeping the money idle, the money will be kept in a bank account or a specific fixed deposits or a risk-free investments, which will earn an interest or some passive income. So predominantly these will be the categories of revenue. Other than that, depending upon the organization you are handling, if they have a property, they would have let it out, rental income, so on and so forth. Now, voluntary contributions. Let us understand how voluntary, so it's a big umbrella. Under voluntary contributions, we have come across situations where, situation one, yes, somebody came, they saw the activity of this organization and look, they are doing good job. We are able to understand the impact they are making in the society. Take 1 lakh, keep it. No other conditions asked. They are impressed with the activities of the organizations. Nothing is asked hereafter. There will be a letter. We are pleased with their activities. Please take 1 lakh rupees as voluntary contribution. Keep it for yourself. No more responsibilities of reporting back what they do with this money. The donee usually writes acknowledging the letter. Thank you for this donation. This is under voluntary contribution. I call it as a general donation. See, I am coining the word for easy understanding of the concept. In the practical situation, in the institutions you are handling, there will be different expressions depending upon the mandate of the management they might be using. But fundamentally, you can apply these principles. There is no specific purpose or specific thing. They are impressed with the general activity of the organization. We call it, our discussion, we call it as general donation. Another category, another donor comes, again voluntary contribution. They came and they got impressed with the activities. Now they will ask, okay, what are you doing for in your operations? They'll say that we are doing vocational training for needy children. We are funding their education. We are even helping the people to meet their medical, many things they are doing. Or they have different projects. Like we have come across organizations where they have projects like giving computers to the needy children in rural schools, or giving them computer education, or giving them spoken English training. Many things, many projects they will run with the different names. Now this donor says that, okay, out of these 4 projects which you are running, I am impressed with this project, which is project number 1, where vocational training, or some projects. They will say that we will give you some money, where this money has to be utilized out of your all activities. Please use the money for this particular project. Or you do the activity in this particular school, or you do this activity in a precise way. And when this happens, there will be an agreement where they will say the purpose is identified. So out of the global purpose, one specific project is identified. And the donor is specifically mentioning that there is a money which is coming in. Proposal, see, usually what happens is they will write a proposal. The management will write a proposal, how they are planning to this project, okay, what it warrants, how much timeline it will take, how much human resources it will need, whether it will need any capital expenditure, whether travel involved. They will write a proposal, and there is a negotiations happen, and they will freeze upon a budget with a specific budget line. Out of this total money, so much you can use as a travel, so much you can use for salaries, consumables, or if any fixed assets involvement that, and there will be a 10% or 15% they will give for institutional budget. What is called institutional budget? Other than the precise salaries and travel, 10% given globally for the support, the overall support given by the organization's passive staff like accounting and all. And an agreement is agreed upon, and based on that, now this project according to the agreement will run upon from 3 to 5 years. So there is a grant agreement wherein this budget is specified, and they will say that, okay, this money will be disposed. Let us say 15 lakhs has been agreed upon, where 5 lakhs will be disbursed upon. First installment, first year, 5 lakhs will come to you, and they will want to know, the donor will want to know that how the money has been utilized, where it has been utilized according to the budget which has been planned. Both the financial report and also the physical execution of the project report will be agreed upon. There will be quarterly reporting, and the donee has a responsibility to report. Please mind, this is not quid pro quo. This is not a service contract. Don't think that this is like a report where somebody is giving money to get the report. No. Here again, the person who is giving the money is not the beneficiary. He just want to make sure that the money has been utilized for the purpose for which it has been given. Beneficiaries are not both these people. Never. That we have to make sure who are the beneficiaries. Now, there is a responsibility for the donee to comply with this utilization of the money over a period of time according to the budget line, and the donor will tell that if in case you are not able to use the money, please give the money back to him, or he will tell that, okay, we will extend the project, so on and so forth. Very detailed agreements will be there. Now here, this is one category of voluntary contribution. Third category of voluntary contribution, the person will give the money. There is no specific project, there is no general purpose. He will tell that this is like a capital, corpus. The word used is corpus. It is like simple term, it may not be a correct expression, but for our reason, like a share capital, they can think. It's a capital receipt, like a fund. They are saying, see, look, we will give you 5 lakh rupees as corpus. What it means? Corpus means the fundamental premise of a corpus is like, it is the money which you cannot use as it is. In both the previous case, the money as it is used to carry out the project. In the case of a corpus, the money is not utilized as it is kept in a specified investment, and basically the recipient organization has to invest it, and any income earned out of it, like in the form of interest, that alone should be utilized for running the project, running the activity. This is that basic definition of a corpus donation. Now, under voluntary contribution, these 3 category comes. Other than that, interest income or passive income will be earned by the organization based on the original source will be this fund, right? Now, what is this 85? Out of this, whatever comes, officer, income tax act says spend 85%. Now, what is it on which we have to apply this 85% and 15%? Question number 1. Somebody has promised whether, see now in the categories of entities, which I mentioned, there is no prescribed, there is no mandatory requirement that you should account this money which comes in on, there is no mandate to follow accrual basis of accounting for a trust society. Whereas, that is mandate for a company under the Companies Act, because when you incorporate a company, you are governed by the provisions of the Companies Act also. Now, the money what comes in the case of these organizations, let us think the financial statements, balance sheet definitely common for all. There is income and expenditure account and there is receipt and payment account. Normally in for-profit organizations, unlike under the Companies Act, there is a need for cash flow statement. We don't make receipt and payment account. We will make only income and expenditure account. Now this 15% should be applied on income or should be applied on receipt. When I say receipt, the actual cash flow in the bank account. Income means what happens? If you are following accrual basis of accounting, the income is accrued, interest accrued will be accounted on accrual basis. Now, whether this 15% or 85% has to be applied on the income as per the income and expenditure account, the top line, or the receipt as per the receipt and payment account, the act as it is silent. But all the provisions for compliance, if you read and appreciate, more and more they are recommending a cash base of accounting is very clear. They have never told it in as many terms as like you should consider it, and nowhere they use the word receipt also, they use the word income only. Now practically, in my example, 3 categories of donations I told, voluntary contributions. First case, general donation, 1 lakh received came in the year with no specific mandate of utilization. Second, 5 lakhs came with the mandate of utilization which will be spent over a period of time, and depending upon the utilization, the next tranche will come. Third is corpus donation. Now how this will be accounted? Let us first understand accounting. Here, accounting also plays a very important role, especially considering this year's audit report. Now the first donation, what I am talking is what I have commonly seen in on institutions which I have come across. You may have a different experience, but you can apply the principle. The first category of donation, point of receipt, the organization is free to do whatever it wants within the umbrella of the objects. There is no specific mandate. So at the point of receipt, it is accounted as income. It is accounted as income, means grouped under direct income. Now second situation, what happens? The money comes in, but there is an obligation to use it according to the instruction of the donor. He is not as free as in the first category of donation. So some of the organizations I have seen following the principles as enunciated in accounting standard for government grants. Though it is not a government grant, the principle is like, to the extent of utilization. See, when I can call it as an income, the so-called income, at the point of receipt, it is a current liability. So I will debit bank and credit the project fund under current liability. And to the extent of discharging the obligation, it is recognized as income in the income and expenditure account. So there is a journal entry passed recognizing the income. This said the expenditure will be there. The grant is recognized to the extent of expenditure incurred. So income and expenditure account top line is a function of your utilization of the money. Unlike the earlier case where at the point of receipt it is an income. The same organization, in my example, 5 lakh received, at the end of the financial year March, only 3 lakh has been utilized. The 2 lakh is yet to be utilized because of the artificial cutoff of 31st March. If you see the financial statement of this organization, the balance sheet will have an unspent money of 2 lakhs. current liability, 3 lakhs will be considered as income top line to the extent of utilization this side represented by salaries, travel or whatever expenditure. And the receipt and payment account will have the whole 5 lakhs coming in because the 5 lakhs came to bank account. Now where to apply this 15%? Now let us understand what the Income Tax Act says. The income you can account on accrual basis is what I understand by when they say that there is a provision, as I told you, 85% you have to spend in the year of receipt, and they gave a leeway. If you are not able to spend within that year, first provision, this is explanation 1 clause 2 to section 11.1. Explanation 1 clause 2 to section 11.1. They told that if the money come in, if the money either received or not received, any other reason, there are two situations. This is the only place where they are actually discussing on accrual basis in the context of section 11, where they indirectly told that if you are not able to utilize the money because the money has not been received, that means what you are considering it on accrual basis, but actual money has not come to bank account, then you can utilize it in the year in which, in the year subsequent to the year in which you receive the money. So they are envisaging a situation where the organization is reporting the income on accrual basis. Or the same clause says that if it is received, suppose, or in the year of receipt, you have received and you are spending within the 1 year, okay. Another situation, I received or about to receive, not able to spend, will not be utilized within the next 1 year, you have another form 10, where you are committing to the officer that I will spend it within the next 3 to 5 years, and maximum period is 5 years, and they brought in amendment. Now we are going to see the amendments. If it is not spent within the 5 years, earlier the principle was that after 5 years, the 6th year, it is deemed as an income. So all these provisions, if you follow, the money is not income. In the sense, you are enjoying an income tax exemption. If you receive the money, you spend the money, or if you don't spend the money, you commit to the officer that you will spend it or you will accumulate it for a specific purpose, the income is not taxable in the hands of the recipient. Income tax exemption is given. If there are any violations of any of these conditions which we discussed, obviously there is a deeming provision, they deem it as an income and tax is levied. This is the sum and substance. So whether the computation has to be made on accrual basis of accounting, accrual basis, or on based on income and expenditure account or receipt and payment account, you have to apply what is happening in your organization. Here in accrual basis, what happens? If you are going by your income and expenditure account and you are following this income recognition method, or you are following cash basis, not following income and recognition method, your income and expenditure account speaks about both your receipt and expenditure, no problem, you will apply. Again, I will go by income and expenditure account. Let us assume, for simplicity of our discussion, cash basis of accounting. So your income and if you are following cash basis of accounting, according to me, income and expenditure account and receipt and payment account should be the same, because no entry is passed on accrual basis. Now they brought in an amendment. They told that unless you actually make the payment, you cannot consider it as an application. Means when you are computing your 85%, if the money is not actually paid, that means if you are accounting the expenses on accrual basis, you cannot consider it as an application. Now coming back to my cash basis of accounting, income and expenditure account has expenses on cash basis, receipt also on cash basis. Now when I make a computation, all the expenses will come to my P&L account, my income and expenditure account. I will gross receipt less 15%, 85% to be spent, all my expenses I will take and I will see if I have spent 85% or not. What will happen if I have paid an advance? As on 31st March, money has been paid as an advance, project advance. Most of these NGOs you will find project advance because they will have a lot of field activity, and there will be people who are carrying out the activities in the field, project advance is given. Now in the financial statements, as on 31st March, the project advance is sitting in the, it will not hit your income and expenditure account at all, because it is a balance sheet item. But in receipt and payment account, the money actual outflow has come. Now you can't consider this expenditure, consider this outflow. So there could be a situation of shortfall. These are all practical situations I am saying. I am not telling that you should make computation based on income and expenditure account, or you should make based on receipt and payment account. There could be a situation, now this advance, what will happen? As on 31st March, it is a project advance. Next year, this project advance gets settled and it will come as by way of a journal entry in the books of account. So journal entry in the books of accounts will hit your income and expenditure account, whereas it will not hit your receipt and payment account, because in the receipt and payment account, last year it is shown as advance and outflow is accounted. Now consistency has to be followed. Now if you have to consider this expenditure which has been which was sitting as an advance in the previous financial year, but in this financial year it is actually utilized for carrying out the activity, this particular utilization has to be brought in through your, if income and expenditure account you are following, it will come to your computation this financial year. These are all the challenges. For example, prepaid insurance. So, coming back to the same computation, same organization, same situation, receipt and payment account. Let us assume the computation is based on receipt and payment account. 5 lakh money came, I will show it as gross receipt. Whatever expenditure has happened will be accounted, and 85% if there is a shortfall, I will commit to the officer that I will utilize within the next 1 year or within 5 years. So, and given the fact that unless the actual payment has happened, they are not allowing the application, it looks like more and more, irrespective of the method of accounting followed by your entity, the computation seems to be simple if you are following the receipt and payment account. Because income and expenditure account will have provision entries, income and expenditure account will have this kind of recognizing the revenue according to the utilization, all these principles applied. So most of the times the income and expenditure account may not be a representative of the real situation, and you will have a decision making situation at the time of making the computation. In my personal experience, I had a situation where I had a personal hearing with the officer, and we were following income and expenditure account and for making the computation and applying the 85%. So he himself recommended, please redo the computation as per receipt and payment, because in my example, grant received and you are recognizing the revenue according to your utilization, but you have received the money. So in the year of receipt, you have a mandate to spend 85%. There could be a situation where as on 31st March, you received the 5 lakh and you never utilized it, and you will recognize the revenue after 1 year. For example, COVID, money came 3 years, the money was never utilized. You will never bring it to your computation. So the officer told that no, you redo the computation based on receipt and payment account. Now seeing this new form, it looks like it is much easier and you will have better control if you do a calculation or computation based on receipt and payment account, is my humble view. You can apply these principles and comply with the provisions when you do your computation. Now, whatever we told so far has already been discussed. Going to the next, yes, yes ma'am.
The first case you said where there is no specific mandate, directly whatever income comes out of it comes as donation. So we will consider that as income or that is receipt.
So now that is in, see now what is the basis of your computation of income? In the case of the money which comes without any mandate, whether you take receipt and payment or income and expenditure account, it will come as a gross receipt, gross income to be applied. No difference it makes, because you are not following income recognition method. Yeah, apply on that whole thing, on the whole thing.
So if suppose if the school is running and there is a specific fee which is coming from every parent and it's a like normal school, okay, normally for poor, and then how do you then the fixed amount is coming from parents. So how do you, I mean the gross receipts you consider it as the 85% you have to spend and that.
Yeah, yeah, because see, you have received the money. The moment you have received the money, you have a mandate to spend. If you are making your computation based on receipt and payment account, suppose you are following
Receipt and payments you want to say cash basis.
cash basis. Yeah, receipt and payment means cash basis, actual cash flow. Suppose you are following accrual basis and you are accounting only, you are following an accrual entry, debit the parent and credit the income. In that case, you are committing to spend. Like you don't have that money, right? You can't meet the 85% because you may not have that money. On overall basis, maybe you will have that money.
But if since very long we have been doing entire expenditure less and then whatever is the surplus and then we are thinking we are doing like 80%.
On that.
Yeah. How do you now change it? What is the repercussion?
Not repercussion, this, now you, in this form, they never envisaged, see, application means your expenses. Now you are making that principle of application only on the net surplus, is what you are saying.
But entirely also we are spending, but
Yeah.
then the thing which was reported was only
See, they never use the word net income or they never use the word surplus.
they are using.
Ah,
And previous seminars also which here has happened, many were saying that the income is the
Net, yeah. So you are saying now in the case of a school what happens, there is a quid pro quo, there is a beneficiary who is a recipient. So there the mandate is different, not like a charitable organization as it is. In the case you have an approval as a charitable organization, you will take the gross fees, you will account all the expenses, take the net amount and you will apply 85% on that. Yeah, yeah. So these are the sections which are relevant for these charitable organizations. Just a summary for when you are reading, this will help. Which are the sections which are applicable, which is the relevant rule and which are the forms. These are the situations where they may not give, the income tax department will not give a benefit of section 11. Where, see, the mandate is the public should be beneficiary. No, public is not becoming the beneficiary, they will not give the income tax exemption. Next, not filing the relevant forms when the mandate has not been met. Not filing the return within the due date. Then the money which has come, sorry, can we take the questions after the session if you don't mind? Yeah, we will finish the session and take the questions, otherwise I may not get time to finish it. So, another mandate is whatever money which has been received, if you are not unspent money, has to be invested in specified modes. So what are the specified modes? Section 11(5) has specifically prescribed where the money can be kept. The premise is like, the idea is to not to enhance the profit, it should be invested in risk-free investments, because the money should be available for the purpose for which the organization is running. The idea is not to maximize the return from the investment. So there are specified modes. So if the unspent money is not invested in specified modes, that becomes a non-compliance. Then anonymous donation, there is a specific section under 115 BBC where they told that anonymous donation. What is an anonymous donation? Who is giving the money? The person's name, address or identity is not is unknown for this charitable organization. Then anonymous donation, there is specific principle of taxation. Like out of the gross receipts, 1 lakh or 5%, whichever is higher from the donation, to that extent is taxable. So there is a principle whereby anonymous donation the organizations cannot take. Then this gross receipt, 20%. If you are falling under any object of general public utility, and if your gross receipts from the activity in the nature of trade commerce. So in the beginning of my session I told, these organizations will not have an activity where there is a quid pro quo, like somebody, I will sell a product and I will get money. But if they are carrying out any activity, suppose during the course of executing their objects, incidental to attainment of objects, they have some activity where they are selling a product, they are giving vocational training and they have some product and they are selling the product and they are getting the money, and that money has been utilized for running the objects of the organization. If you are in specific limb, there is no restriction. If you are in the general limb, there is a restriction of 20%. Now there is an organization falling within the definition of the general limb, and if the gross receipt is more than 20%, here the word is receipt, not the net. The gross receipt is more than 20% of the total receipt. The word receipt itself is used in the act, not income. If it is more than 20%, then the organization is deemed not to be a charitable organization, and there is a principle to do the computation of profit. Specific deductions are allowed, specific deductions are not allowed, and there is a mechanism by which the profit is computed and the income tax officer will levy a tax on that profit. If the organization no longer enjoys the status of charitable institution, obviously the tax will come. Then, not filing the return within the due date, non-maintenance of books of accounts. This was an amendment brought in where till the amendment there was no specific mention of the books and records what has to be maintained by these organizations. They brought in an amendment where they have got a detailed guidelines of the maintenance of books of accounts. Even in the audit report, the new audit report, we are expected to comment on the maintenance of books of accounts. Then accounts not getting audited, and there are certain categories of income. All these principles I have already discussed, where the organization has unspent money, not filing the forms, the organization is not depositing in the specified mode, or the money is utilized for the benefit of specified persons, or the money is being utilized for charitable purpose outside India. One of the mandate for enjoying the income tax exemption is, unless there is a specific order, the money has to be utilized for activities to be carried out in India. If any of these violations happens, it is considered to be a deemed income. It is called specified income. Tax is levied at 30%. Then amendments, corpus donation. We understood what is corpus donation. The original money, the original receipt is not supposed to be utilized for the purpose, only the earnings out of it has to be utilized. So they brought in an amendment saying that if at any year the organization was in a position that they can't utilize, there was a need of money and they had to utilize this corpus donation for running the organization, for meeting the operational expenses, then that can be considered as application. When I say application, as part of that 85%, only in the year in which the money is plowed back. This is an amendment which they brought in Finance Act 21. So that is why in the new form, even in the ITR, they have asked us to bifurcate the disclosure of corpus donation up to 31st March 2021 and the corpus donations received after 31st March 2021. This is an important provision. So you have to go back to their clients' books and see if any part of the corpus has already been utilized. Then that portion which has been utilized cannot be considered for 85% application in your computation till you put the money back to the corpus. Same principle they have applied for loans and borrowings. If the organization is utilizing, running the expenses out of loans and borrowings, it can be considered as application under 85% only in the year in which the money is repaid. Then this is another amendment which I told, the application, suppose in a year, the organization had money and they spend more than 85%. There could be a situation where they spend 100%. In that case, what will happen? Will they allow, okay, I spend more this year, will they allow a carry forward or set off for the next year? No, they don't allow a carry forward or set off for the next year. They have brought in by way of an amendment. And this I have already discussed, books of accounts, audit, and the major amendment which we are going to see the form now. They brought in earlier, there was only one audit report, and when audit is mandated, when the gross income is exceeding 2.5 lakhs before applying the exemption provisions, then there is a mandatory audit for these charitable institutions under the Income Tax Act. This is in addition to the audit under Companies Act if it is a Section 8 company, or Relevant Societies Act and if it is a specific society. So under the Income Tax Act earlier 10B only was the audit report. Now they have brought in by way of an amendment two reports. One is 10B and 10BB. 10B is a very detailed report and 10BB is a minor version of 10B. Now, which are the situations under which we have to use 10B? Very precise. If the total income, again the gross receipt or the income on which you are applying 85% according to the method of accounting, system you are following. If it is more than 5 crore, then you have to use 10B report, or it is or condition, or you have received a foreign contribution as per the definition under Foreign Contribution Regulation Act. Even if your gross income is less than 5 crore, if you have a foreign contribution, you have to use 10B. Here, one thing you have to keep in mind, foreign contribution receipt need not be only a contribution in that sense like a donation or a grant. Even an interest income earned on a deposit is a foreign contribution within the definition of FCRA. So if it is an interest on deposit income also is there, you may have to file Form 10B. And income outside India. Utilized. Actually, this is one of the conditions. One of these conditions, if saying you have is applicable, you have to use Form 10B. In any other case, Form 10BB has to be used. Now, this is a summary of the structure of the form, which anybody who sees the form, easy way to understand, because the form is so cluttered, at least I found it very difficult. But one good thing what they have done is, those who have seen the form, in the left side of the form, I have a form here. So this is the form. Is it visible? Is it better? Okay. Somebody has to help. So this form has, in the form left hand side they have given headings. So this is the form. So this left side is, so the first, actually this whatever I am talking is annexure. Our audit report, like our 3CD audit report, the first page is where we are certifying the true and fair view of the financials accompanying the report, and there is an annexure. So this is the audit report as it is, where we will mention our UDIN and all. And if you have any observations or comments, we have to mention here, like our 3CD reporting. Coming to the annexure, objects, this is one thing I want to tell. As I told you, there are two forms, Form 10B and Form 10BB. What we have done is, I said the 10B is a minuscule of 10B. this yellow color thing, this will be shared to you. We did a comparison of 10B and 10BB, and yellow color things, the question is, the purpose of the question is same, but there are some change in the wordings, or there are additional questions asked in 10B. I thought quickly somebody can appreciate what is the difference between 10BB. So this will be shared to you. These yellow colors are for that. Wherever there is yellow color highlighting, there is some change between the question asked in 10B. Either there is extra wording or extra reporting in 10B and 10BB. Some of the, where there is no yellow color highlighting, the questions are similar in both the forms. Now, objects, as I discussed, is over. Commencement, then details of registered office, advancement of object of general public utility, TDS. So, there were situations where TDS was happening, and we were filing the computation claiming the TDS. In 26 AS, TDS will come, it will be imported into the tax return. So, tax liability is 0 and full TDS refund we were asking. And there will be interest on interest income also. Now this time, immediately after that business, they have asked, and that too under section 194C, J, H or 194Q, which has the characteristic of business or a trade. 194C is a contract, 194J is professional receipts, and they are asking us to certify this. Now we are certifying the TDS receipt. I don't think in any audit report we are certifying the TDS receivable, right? So this is a new thing. Here what we have to be careful. Now whatever has happened for this financial year, there is nothing we can do. But in future you have to tell the client, see look, you may have to educate the client saying that we don't know in future how the IT officer is going to view this, because those numbers which are getting reported here, he may say that this is not in the nature of voluntary contribution, irrespective of the underlying document. He say that it is a service contract because they have done a TDS. So please educate the client as to when they enter into the grant agreements, when they enter into the specific MOUs with the donors, they have to be very sure, and they have to tell that what categories of organizations they are. And if required, if they say that there could be a situation, especially CSR grants and all, they might say that we will do a TDS. In that case, the donee organization, the recipient charitable institution may have to take the pain of making an application in form 13, where specifically it is donor specific. You have to mention the name of the donor and make an application to the income tax officer, and he will call for documentation, and if he is convinced, he might give a 0%, or nowadays they are giving 0.1% TDS. So at least you can substantiate to the officer that, see look, so the document, the officer is already aware, they are not relying on this audit report. So if TDS is there, even if there is a question, you can prove that it is actually in the nature of grant, but the donor has done a TDS, but definitely there is no non-violation of charitable purpose or non-intention. There is no quid pro quo. Now, next, this is TDS. Then next, the provisions of section 1310. So section 1310, question number 20, section 1310 is an amendment where it is again violation. One violation under section 13.8, that 20%, if it is exceeding 20%. Another, books of accounts not getting audited or books of accounts not maintained. If any of these situation happens, the officer may take a stance that you are not, there is no charitable purpose, and he will do a computation of profit, and this 1310 talks about a situation where how profit is computed and what will not be allowed as a deduction. That is section 1310. Then next is a very, very critical table where we have to really focus. 10BD, as you know, last year they introduced a new form called 10BD. First of all, at least our understanding was like 10BD is introduced something like 26 AS, they want to make sure that nobody is claiming a wrong claim of ATG. As you know, these charitable institutions, those who have approval under section 12, they will have two approvals actually. One approval under section 12 where they themselves are income tax-free organizations, and the person who makes the money, see, they have to get voluntary contributions, so as an incentive for the people to donate to these organizations, the Income Tax Act has a section ATG where the donor will get a benefit of 50% normally. Otherwise, specific case 100%. Now, there were situations where there was no mechanism so far, I would like to say like that, there was no mechanism to cross-check between only document we were asking was a receipt where there will be a PAN number and approval number, registration number, and the donations were claimed as deduction in the respective tax computations of the donors. Now last year they brought in this form 10BD where there is an obligation cast upon the charitable institutions to report to the income tax department the details of the donors and also categories of donations, whether it is a specific grant or others or a corpus, and they had to file it by May 31st. Now that time we really thought that this is only a cross-check mechanism to make sure that the donations are substantiated. We also recommended people see foreign contributions where people may not claim an ATG in India, no need of reporting, and we applied our own, there was no specific guideline or anything, so we applied our own principles and filed. Now this year, this table says that it is no longer a document to prove the validity of the donation. It looks like this 10BD is very critical because this form is used as a basis to do a reconciliation of the total voluntary contribution. This is what I told you. You need to know that global umbrella of voluntary contributions. Under voluntary contributions, now total umbrella of voluntary contributions, what is getting reported in form 10BD? They want the auditor to do a reconciliation. And the reconciliation is a very detailed reconciliation where what donation you received, what is reported, what is not reported. Now, if not reported, why it is not reported? Is it because it is not eligible for a deduction? For example, cash donation more than 2,000 rupees is not something, it is not allowed. They cannot take a cash donation more than 2,000. So, is it reported for want of compliance, or is it not reported for want of availability of the details of the donor, or any other voluntary or is it a foreign contribution? And also there is a blanket clause where any other reason why, for example, government grants, it may not have got reported in 10BD because there will not be availability of the data like PAN number and all. So they are asking us to do a very detailed reconciliation. This is going to be a really tough task. And hereafter this year already they would have filed the form because May 31st they extended the due. By June 30th they would have already filed 10BD. This year it is going to be one kind of challenge. But next year what we can do is on proactive basis. At the time of filing form 10BD itself, this reconciliation table has to be completed. According to me, if you do that, if there is any correction which they have to do, they can do at the time of filing itself. See what happens if during the course of now we are going to do the audit and we find that there was a receipt which was actually in the nature of a donation which they should have reported in 10BD and it was not reported in 10BD. What is the consequence? We will recommend the organization to please report it in 10BD. Then what happens? There is an option to revision form 10BD, but very, very peculiar. You can only revise the data which has already been reported. Any new data you cannot include. If you have to include a new data and file form 10BD, you have to file a new 10BD form which attracts a penalty of I think 200 per day. So this table is very critical. Please, I think lot of time will be required here to do the reconciliation and find out why why that has not been reported. Sorry ma'am, I'll just finish. I'll take your question after that. So this table is very critical. Please do a reconciliation. If at all, if you have not started the audit of any of these organizations, this is the work which you have to do immediately. And here the accountant may not be able to give answer also. You may have to go to the source document. What is the nature of if it is a donation to be reported or not. And here they are capturing the anonymous donation also. Anonymous donation definition has to be seen. Also, if something was not reported where they have no details, at least recommends the anonymous donation is taxable. There could be, the accountant would have taken a stance that we didn't collect the data. One case we came across that the donor was not keen in claiming ATG. The money came and the recipient organization, the person told we don't want that benefit. So they never collected any details of the donor. Now, in the interest of this, because it is a donation, it should not fall as anonymous donation. If it is anonymous donation, it is taxable for a charitable institution, not for religious organization. It is an organization. So, in the interest of the organization, even if they don't want to claim ATG, please collect name, address and details because it should not be anonymous. Going forward, so finally here it is a self-contained form. So if you fill in the basic data, automatically the computation. I understand the utility has been just released in the form, in the portal, the income tax utility. Now we are waiting for the third party software, those who are familiar with Winman or Saral software. The data, automatically the computation happens. If you key in the information, you will arrive at, the form is designed in such a way that what contribution or what total application amount the organization is supposed to spend will be automatically computed in this particular form. That is as far as voluntary contribution is concerned. Going forward, the next table is income other than voluntary contribution, as I told you, interest or rental income or anything, what is to be applied, where there is an obligation. The obligation to spend 85% is not only on voluntary contribution, even other receipts are also, they have that obligation. So that is captured in 28, 29. And finally, after all this, 27, 28, 29, you will get in line number 30, income required to applied in India by the auditee. So that computation is already calculated. And the next important table is application. To meet your 85% criteria, the big table application here, first, if you remember in ITR 7, they captured out of the total application, what is spent for that specific purpose for which you have been, your objects have been classified. Is it relief of the poor or preservation of environment or preservation of monuments? What is specific limb or general object of utility, and you will classify. So you will make your income and expenditure account or receipt and payment account, whatever, and you will classify out of the total expenditure how much. They used to ask establishment and administrative expenses separately, and those has been spent on the core objectives. Obviously there will be establishment expenses. For example, the rent of an office where no program is happening, only administrative office, that cannot fall under that specific limb because it is a support activity. So now the same has been followed, but with additional mandate of, you have to classify out of the application what is met by electronic means, and electronic means defined. Electronic means all the through banking channels and other mode. So here is a real challenge practically, where the cash expenses, whatever met out of non-electronic modes, has to be bifurcated out of two application. Now real practical situation I will tell you. In my example, I was quoting that project advance. If you go the accounting entry, the debit project advance, credit bank and project advance, if you are following income and expenditure account method for your computation, it will not form part of the computation. Now next year it will come by way of a journal entry. What is journal entry? Debit expenses, credit advance. There is no cash expenses. The cash book will not have any entry of this example. You are able to understand. But actual utilization would have happened by cash, because the field people, they would have employed 10 volunteers to give the education, or if it is some cleaning work, cleaning the Kalyani, some 25 people they would have employed labor to clean the Kalyani. The organization's mandate is to prevent pollution. The final disbursement done by the project leader will be in cash, and you will have a cash voucher, but no cash entry in the books of account. If you have to find out how, now when you report, will you report it as electronic or will you report it as other form? I don't have an answer, because from accounting point of view, in the books of accounts, it is only a bank entry and a journal entry. There is no cash entry, but we have cash vouchers where money has been actually deployed in cash. Now whether you will report as electronic form or other modes has to be, the stance has to be taken depending upon the organization's system. And if you, okay, this year, now that stance what you are taking has to be continued. Now some of the organizations, maybe their bandwidth is such that they are able to collect that data, like out of the advance given, how much was actually given by cash, and how will you bring to books of account, because definitely this is a journal entry. Or now system wise, accounting system only has to be changed. When I say accounting system, how are you going to capture this non-electronic means? I cannot disown that. Now tomorrow income tax officer will say, you have finally disbursed the amount by cash, there are cash vouchers, you should have reported in cash, you cannot report it in electronic form because it is a journal entry. We don't know. Now these are all real challenges for which there is no answer at this point. Maybe guidance note or something might help from our institute. But capturing the data, reporting the data, lot of judgment is involved, and it is not something which you can take decision immediately. And this is something which we have to certify. Definite challenge when you finish the audit for this financial year. Next one, in the application, this is one major thing. Other thing is, more than 50 lakhs, that applicability where their TDS has to be done under 194Q, that they are asking specifically. Perhaps this report they are using as information where the organization has paid more than 50 lakhs to one person. Have they complied with the TDS provisions? That is one precise question. Then here, next, very important. If you see here, they are asking amount which was not actually paid during the previous year. This is the amendment of explanation 5 to section 11, where they told that unless you actually make the payment, you cannot claim it as an expenditure in the year in which it is accrued. So here there is a work for us in the computation. You have to make sure if you are following your income and expenditure account to do your computation, any accounting entry based on accrual basis, and the organization is following accrual basis, you have to check the computation and report that accrual things. Then earlier accrual paid during the year has to be brought into the computation, because last year it was accrued, you cannot consider. This time you have paid, whether that can be considered. That is earlier liability also they may not allow. Now after putting, there is a in point number 5, total amount to be allowed as application. So once you give the information, the computation is done, and what can be applied, what can be considered as application is computed. And again from the application, as you know, one speciality of this charitable organization is out of the total expenditure, what has been spent on capital expenditure, purchase of asset, as it is, it is not depreciation, it is the purchase of the asset, that value itself is considered as an application. So one of the, under section 1310, one of the thing is, if you have claimed any depreciation, you can't claim a depreciation if you have already claimed the cost of the asset as an application. Now capital revenue bifurcation we have to do, and unspent money has to be invested in specific modes. And here these two, 7 and 8 are specifically based on that amendment where we discussed, if money is met out of corpus, unless you plow the corpus back, you cannot claim it as application. So if not plowed back, you have a specific corpus table, or if you are familiar in ITR 7, that table is now part of this audit report also. So if it is not plowed back, it cannot be considered as application. Then any expenditure out of borrowing, if not considered as application, if not repaid, you cannot consider as application. Other specific disallowances, 48, that TDS provisions under section 40A and 40A, cash payment more than 40A3, then non-TDS, where TDS has not been done, it is a disallowance. All those provisions, though it is under business chapter, has been made applicable to these charitable institutions. Though that amendment came, I think 2 or 3 years back, so far there was no specific reporting in this regard, but now in the audit report we have to do. The consequence is, we have a detailed TDS table, like TCD reporting. We have a detailed TDS reconciliation table where we are supposed to go through the expenditure, see where there is applicability, where they have done TDS, where they have not done TDS, short deduction, non-deduction. All those we have to capture as a part of this audit report. There are schedules and you have to report, and accordingly the disallowance is computed. So amount to be disallowed, once you answer all these questions, that is automatically reduced from the amount which can be considered for application. Any other disallowance which is coming to the observation, coming to the notice of the auditor, we can report here. And finally, from the total application, what can be considered as application for this year as a part of that 85% is computed as a part of this form. So literally, we are taking responsibility for the computation. That is the answer. So far, the audit report, auditor has no responsibility to see. We sign the financial statements. Even in 3CD reporting, specific allowances, specific disallowances, they will ask. But here, the overall, we are actually certifying what is that 85%. What is the gross income, what is 15% computation, and what is 85% we are certifying. Then 115 BBA, I told you specified income where there are violations. The definition is very clear. That has to be reported here. All are in the form of questionnaire, and one good thing is they have given the precise section. So if you open the section, without that we can't work on this audit report. Then any other income where this section 12.2, it is so anonymous donation chargeable. This any other income is like if the charitable institution is running an education institution or a hospital, and if any benefit is given to the specified person, see, as it is benefit as it is given is not a violation. That value you have to consider that also as an income. That is what section 12.2 says. If there is no billing to that person, take the value which is billed, the arm's length value, and you have to report it as an income. As it is not a violation, but if it is unreasonable, there could be. Now, corpus, there are mandates where if you have accumulated the income. You have committed to the officer that I will spend it within next 1 year or 5 year. And next 1 year, if you make any, you can't make any corpus donation out of that. This organization which they have committed, they will spend, they have to spend on a purpose, but that purpose cannot be a corpus donation to another organizations. That is what, that particular section where they are asking. Then, ATG income ATG under clause ATG2. See here ATG2 is where the donation has been given for the repair or renovation of a Gurudwara. If you have come across ITR 7, they are asking specifically any corpus given for that repair, renovation of any Gurudwara or temple. There are conditions prescribed where they have to be specifically utilized for that, and if unutilized money has to be specifically deposited. That is what they are specifically asking here. And 11.4, as I told you, business undertaking, and if you have computed profits and gains, the income tax officer can challenge that profits and gains. Here it is profits and gains and not income. Please read section 11.4. And if your profit, what you are declaring, which is eligible for section 11 exemption, and the officer says no, your profit is much more from that business undertaking, that difference becomes chargeable to tax. That they want to capture here. Next, another block is for capital asset. As I told you, purchase of capital asset is considered as application. Transfer of capital asset, the money what comes in can be utilized for objects of the organization, including purchasing another capital asset, or even you can use for the revenue expenses also. That specific questions they are asking here, whether there is any transfer and whether the money has been utilized. All those questions are very straightforward. Then, this is an important table. We discussed about application. Now you see the flow. They captured all the application, then they captured all the disallowances, they captured capital and revenue. After minusing all the disallowances, you arrived at that application which is eligible and which forms part of 85%. Now they are expected to report here the source. What is the source? Whether the money was, that utilization is out of current year receipts or whether your earlier accumulations. In my example, imagine last year the client has committed that I will spend within next 1 year. So in this year what happens? Already last year computation you already committed that you will spend within 1 year. It is a deemed application already considered in the previous years and you are given the benefit of 85%. Now that again you cannot consider in this year. Though it has come in your receipt and payment, you have actually paid this year, but you filed a Form 9A in the previous year. What is Form 9A? That you committed to the officer that I will spend within 1 year. As on 31st March 2022, you committed that I will spend within next 1 year. That comes in financial year, this financial year. This financial year, the utilization has happened, but already the benefit has been enjoyed last year. That you cannot consider as application this year. Then, accumulation. I committed to the officer that I will spend it for a particular purpose. But either purpose was different, purpose was changed, or never utilized, or unutilized money was not spent in the specified mode. All those things will come. Now, even in the application, this year there was no, the receipt was, there was receipt for the year, but the actual utilization was more than the receipt. You received only 5 lakh, but you actually spend, say 7 lakhs. Now the 2 lakhs, from where did you spend? Whether you spend out of whatever 15%, your general money, whatever 15% you saved every year. Because the mandate is you spend only 85%, right? So that 15% you have it in your balance sheet. Whether did you meet out of that, or did you meet out of your corpus? Did you meet out of your borrowed fund? Did you meet any other? Here I have a view, I don't know the answer, maybe there are two views. One is, are we expected to, are they saying that out of the total application, these are the sources where which we cannot consider as application this year. For example, amount spent this year, but cannot be claimed as application this year because already it is considered in the last year. Such special categories they are capturing here. Now any other means, the money which actually spent out of the current year also I have to report here, or out of the total application, only these categories alone am I expected to report here. It is not clear. Do I have to do a reconciliation of the total application and report the source? Because if you remember in ITR 7, those who are familiar, out of the total application, we were expected to reconcile the source of application. Those who have filled ITR 7 can understand this. Total application is say 500 rupees. This 500 rupees, what is the source? Is it out of current year receipt, or is it out of your earlier accumulation, or is it out of your 15%? We were expected to match that reconciliation. 500 has to match. The source and the total application has to match. In ITR 7 still it is there, but in the audit report, do I have to do a matching? If I have to do a matching, there is no specific question where application out of the current year receipt, there is no sentence. So any other, yes, I will close it. So any other, whether I have to consider the current year application, current year receipt or not is a question. I think when we fill up the form, if there is a validation error, where they say that the total application there is a mismatch, means in the any other we have to report the application met out of the current year receipt. This we have to see how the form is allowing. There is no instruction also. This is one challenge I am foreseeing. Other than that, application, that disallowances, all those things, finally, you will, the questions are pretty straightforward. All the violations they are asking, which will not allow you to claim it as an application of your income. Then, going forward, the very next major question in this is about the transaction with the specified party. Specified parties, an author, the founder, the director, any relative of these people or any concern in which they have interest, substantial interest is interest more than 20%, substantial contribution, any major donor, all those things are specified people under section 13(3). It is defined. Now, the benefit given to the, actually it is a violation. If you are giving undue benefit to a specified person, it is a violation under section 13(1)(c). Now, here, very detailed questionnaire on transaction with specified person. The main change in this is we are expected to comment on the adequacy and reasonableness of the salaries paid or compensation paid, which I already discussed. So I don't want to elaborate on that. The tables are pretty clear, questions are pretty clear. Be alert on this. There could be a legacy issue. Now already it is done. Now how we are going to comment on the reasonableness or adequacy of the compensation is really a challenge. We have to have enough documentation to say, suppose one of the trustees is a scientist and they have been given a consultancy, or one of the trustees is an operations man and the time is spent. We may have to do a market study for his time and his experience, and the time spent to the organization, the compensation given is adequate. We should have a documentation and working paper to prove. Or we may have to even, I think officer might come back and say, how did you certify it is reasonable? How did you certify it is adequate? Here, I think additional role of assessing officer also cast upon the auditor. That is something it is a new thing. I mean, it's not, because even in 40A to be reporting, I don't think that we don't have to comment on the reasonableness. That discretion is with the assessing officer. We only have to report the transactions with the related party. Then there are specified schedules. Most of the schedules are relating to corpus, then TDS table, specified transactions table, then so if you fill in the table, the information will flow. There is a separate section on specified violations. Most of the violations which can be done by the organization I have already discussed. So if any of those categories, not meeting the purpose, not investing in the specified mode, undue benefit to the specified party, not utilizing the money within India, all those things are specific violations, or not spending the money within the 5 years, or giving corpus out of the accumulation. These are all the violations. I have a separate slide on where this, actually section 13 specifically say, income on which section 11 do not apply. Section 13 full discusses about various situations where the organizations will not get the benefit of section 11. In addition to that, please go through section 12 also, because there are the conditions based on which the approval has been given. If you see, you have come across all the cases where they have renewed 12A or new 12A, they have given the conditions under which the they are expected to follow, and the assessing officer has the discretion to cancel the registrations. So all those are specifically discussed in specific violation. In addition to that, violation under any other law also is expected. So if under FCRA, if there is a violation, that we are expected. It is like pending litigation reporting under Companies Act. So that has to be reported. Then chapter 17B, last question is whether the auditee is required to deduct or collect as per chapter 17B. So in this one question, the entire TDS compliance has been expected to report. In addition to that, like tax audit report 269SS, 269T, all those loan, borrowing more than 20,000, less than 20, then 2 lakh, more than cash receipts, all those questions have been addressed here. The tables are pretty straightforward. Then I think now I can take up some questions. Otherwise, of the dais also I can take up the questions. Yes.
Like a person gives a donation, check or online mode, but
So this is a case where it is not an anonymous donation, but they may not be able to report in Form 10BD. So there is a specific question, donation has to be reported, but for want of details not reported. There is a specific question.
Will that be taxable under,
No, it is not anonymous because you know the person. So anonymous donation is defined. There you don't know, like a hundi collection is an anonymous donation. In this case, it is not anonymous, but for want of that PAN number, you are not able to report in 10BD. That is one line item in that voluntary contribution table, ma'am.
thank you.
You can report it there.
Registration or ATG. Now what they have to do?
So 12A ATG not there, straight away section 56 will attract, sir. The contributions received is taxable.
Now even if we take registration also.
Now before March you can't take, now you can apply and get registration, then hereafter if they get approval, hereafter whatever they receive they can enjoy the benefit of section 11.
Okay.
Yes, that last sir, actually I told him not to ask the question.
Madam, you are advocating that grant received for specific purpose has to be considered for the gross receipt
Yeah,
while computing.
Yeah, I'm not advocating, but for computation basis, so depending upon, see, consistency is very important. See, fundamentally, what is the purpose of the legislation, whether you have spent or not? If you are not considering the grant as gross for the purpose of applying your 85%, what is your basis for considering that 85%? That has to be consistently followed. To the officer, it is easier, I find at least in my experience, it is easier to follow the computation based on receipt and payment account, so that the control is very clear and unspent money as on 31st March will be available in the bank account, and you can commit that you will be spent within 1 year or 5 years depending upon the situation. Income and expenditure account has, it is not as straightforward as a receipt and payment account. That is the only reason.
The computation methodology is different, whether it's from income and expenditure or receipts and payment. My basic question,
Yeah.
if we consider grant as a receipt for the computation, then the 15, I will enjoy the 15% benefit.
Yeah,
Is
yes.
it correct?
Yes, I got your question, sir. I'll answer. That's actually a very good question. See, some donor will give a grant and he will never tell that you have to, you can keep 15%. He will insist you have to spend 100%, right? This 15% and 85% is a deeming fiction for the purpose of Income Tax Act. So what happens in your overall computation, you would have actually spent more. Means you would have actually utilized the full grant, but you are expected to spend only 85%. So that way you will not have a to be spent situation. In the sense you will not have an accumulation. In fact, it is beneficial for you if you are following receipt and payment method. Now, Income Tax Act is not bothered about what the donor says. Yeah, sorry, you can take the mic, I can't hear you.
It is a specific grant,
Yes.
I have to utilize completely.
Yes.
How do we expect that the income tax would allow 15% on this? It's a specific, I would consider, generally I would account it as a liability.
Huh.
Apply, I will debit it to the liability. I will not take this into the income and expenditure or the computation.
So here is one view where, in fact, one of the income tax officers only told that wherever you are receiving a contribution with an obligation to spend according to the instruction of the donor, it need not come to your computation at all, because that 85% mandate you can't apply because you have no choice, you have to spend. It is a liability and it is closed at the balance sheet level. Don't even bring it to computation is one view.
That is
That's
what
we
we follow, madam. That is what we follow.
So that's what, consistently it is your assessments are getting over means fine, sir, no problem. Officer is accepting. I have never tried that. So if an officer is willing to accept that thing, it is fine.
I find it is more logical than.
In this voluntary contribution table, that will never come as a part of
Correct,
that at all.
correct.
Actually, in fact, one of the income tax officer, in fact, when at the time of scrutiny, she asked me that question, why are you bringing, because my assessee had predominant income in the nature of grant and very thin donation. She told, don't bring that whole thing to the computation at all. Why are you committing this at all? You would bring only the donation with no mandate into the computation. That was a very welcome thing, but it is a question of courage, sir.
The other question is in Form 10BD, if I don't report in Form 10BD, voluntary donation, if I report it as other in the column which has been prescribed in Form 10B, would it be sufficient?
No, any other and specify. You can give the details and your premise under which you have taken that chance, and if required, you can even submit a written document along with the audit report, sir. Because this has been consistently followed. So
It
you can
cannot
follow
be
it.
an anonymous donation.
cannot be an
I
anonymous
have the
donation.
document, but I don't want
Yeah,
to
it is
upload
not,
it.
it is not anonymous donation, sir.
Yes, sir, thank
Yeah.
you.
Okay, any other questions I can answer off the dais also. Thank you very much, Bangalore branch, and also patient listening to each and every one of you here. I know it is very complicated, and I don't know how far I was able to communicate it to you. And also here one thing is there, yes, this has come, this is my personal note, this has come at the time which is, we don't have that enough time to finish it. And this year is really going to be a challenge. As I told you, there will be legacy issues. You have to get into the accounting level. You may have to really see what they are doing and bifurcating the data. All those things will be a challenge. But in future, for future compliance, I think this can be used as a wonderful tool to make sure that the charitable organizations are complying with the provisions, because we as an auditors have a responsibility cast upon us to make sure that the statutory provisions are complied with. So those who are not following it for want of ignorance also, please advise them, please use it as a tool to make sure that, and enable them. And now the trend is like anybody who apply for 12A ATG, the provisional will come faster. In fact, I had a discussion with Commissioner also, like he is saying that we enable the people to do what they want, and after 3 years when they come for renewal, please make sure that you have complied with all the conditions. The violations what they have told are very genuine, because there is a mandate to spend, please spend it. There is a mandate to utilize for the purpose for which it has been given. So this we can really use as a tool to make sure that they comply with the provisions. And thank you for patient listening. I want to thank my partner Rekha ma'am also, because what I spoke here is, and I have learned from her, so I remember you ma'am, thank you. And thank you all for listening. Thank you.
Like the speaker said, the charitable trust concept itself is becoming tougher day by day. In the last 3-4 years, the way amendments have happened, whether it is in FCRA or in income tax, in fact, the Finance Act budget, most of the sections are towards, the budget itself is towards the charitable trust than the other subjects. So it is a complex subject, and running a charity is not easy. Similarly, auditing a charity is also not easy. But with her expert knowledge today, our speaker, CA Rani, has helped us understand it better. So definitely it was a very inciting session, and thank you so much, ma'am, for your time. On behalf of Bengaluru branch, we express a deep gratitude for your time. Yeah, I would request our VC, Pramod Hegde, to hand over a token of gratitude to ma'am. Can we have a big round of applause for our speaker? Yeah, thank you, ma'am. So we will break for the tea now. It's arranged in the cafeteria for 15 minutes, 10 minutes, and we'll assemble again for this next session.